Imagine a company that serves the single most economically squeezed demographic in America.
Right, the lower income consumer base.
Exactly. I mean, you have this core demographic that is actively being crushed at the gas pump. They are just being suffocated by stubborn, lingering inflation across the board.
Yeah, and the basic physics of economics dictate that when this demographic gets squeezed, they spend less. I mean, the retailers that rely on them usually suffer.
It's supposed to be a mathematical certainty, right?
It is.
But now imagine that same company operating in that same brutal environment just grew its profit by 38% in 3 months.
It completely breaks the textbook. I mean, when the consumer is supposedly at their absolute weakest, this retailer is somehow finding a way to flex its absolute strongest financial muscles.
Yeah.
It's honestly the definition of an economic paradox.
Which is exactly why we are here. So welcome to a special Talk Tickers edition of our Deep Dive.
Glad to be here.
Our mission today is it's laser focused. We are taking the Dollar Tree Q1 2026 earnings call, which, just took place on May 28, 2026. And we are going to look under the hood of ticker symbol DLTR.
A fascinating one to dig into right now.
Seriously, if you are an investor or even just someone fascinated by the mechanics of retail, we are going to break down the hard data, translate the Wall Street jargon, and give you a decisive, actionable look at how this discount giant is navigating a really incredibly volatile landscape.
And we really need to emphasize just how volatile that landscape is right now.
Oh, totally.
If you listen to the leadership at Dollar Tree, specifically CEO Mike Creeden and CFO Stuart Glendening, they are not sugarcoating the macroeconomic headwinds at all.
No, they're not.
You have intense uncertainty around fuel costs, which is being severely exacerbated by the ongoing conflicts in the Middle East.
Right.
There's looming, highly unpredictable questions about international tariffs. And you have a core shopper who is heavily reliant on tax refunds just to make it to the end of the month.
That's a very precarious cocktail. So I am looking at these headline numbers, and my immediate reaction is just how? How does a retailer dramatically increase its profit margins and entirely blow past Wall Street's expectations when the people walking through their doors are hurting this much?
It's the big question.
Let's just put the raw data on the table. So, total net sales for the quarter increased 7.2% to hit an even $5 billion.
Which is a staggering volume of merchandise when you remember that the vast majority of those transactions involve items costing less than a cup of coffee.
Right, exactly. But the top line revenue is just the start. It flows all the way down the balance sheet in a major way. Adjusted earnings per share, or EPS, grew by 38% year over year to $1.74.
And that didn't just beat what the analysts on Wall Street were predicting, right?
No.
That beat the very top end of Dollar Tree's own internal management guidance.
Which is wild.
Precisely. I mean, management teams generally set their guidance at a hurdle they know they can clear. It is an exercise in managing expectations, you know.
Under promise, over deliver.
Exactly. So beating your own absolute best case scenario by a wide margin in retail right now is exceptionally rare. And there are two other critical numbers here. Comparable store sales rose by 3.5%. And their gross margin expanded by 120 basis points.
Okay, let's unpack those last two metrics, because if you were trying to understand how massive corporations actually operate, we really need to strip away the Wall Street speak.
For sure.
Let's start with comps, or comparable store sales. I hear this term thrown around on every retail earnings call. Why does that 3.5% number matter so much more than the 7.2% total sales growth?
Well, it matters because buying top-line revenue growth in retail is actually incredibly easy.
Wait, easy?
Yeah, if you want your total sales to go up by 10% next year, you just go out and aggressively open 10% more stores.
Ah, okay.
If you had 1,000 locations and you build 100 more, your total sales are going to rise simply because you have more physical cash registers ringing up items.
I always think about it like a lemonade stand.
Okay.
If I run one stand and make $10, and the next day I build a second stand down the street and make another $10, my total revenue just grew by 100%. I'm taking in $20.
Right.
But my original stand didn't actually get any better at selling lemonade. I just bought more real estate.
That is the perfect analogy. And Wall Street knows that trick, right? Total revenue growth doesn't tell you if the underlying business model is actually healthy. It just tells you that the real estate acquisition team is really busy.
Yeah.
Comparable store sales, or comps, they strip out that artificial boost. They only measure the revenue generated from stores that have been open for at least a full year.
Got it.
It is the purest diagnostic test of a retailer's organic health. So a 3.5% comp increase means that the exact same Dollar Tree locations that existed last year managed to generate 3.5% more revenue this year. The core engine is actually running hotter.
Makes total sense. Now let's look at the other phrase, gross margin expanded by 120 basis points. To a normal person, a basis point sounds completely abstract.
Yeah, it's very finance heavy.
What does that actually mean for the cash sitting in Dollar Tree's bank account?
In financial terms, 1 basis point is simply 1/100th of a percent. So 100 basis points equals 1%. When they say their gross margin expanded by 120 basis points, it means their margin went up by 1.2%.
Which, I have to be honest, sounds like a rounding error. Like 1.2% sounds tiny. If I get a 1.2% raise at work, I'm probably looking for a new job.
I mean, true, it sounds tiny until you apply it to a company doing $5 billion in quarterly sales.
Okay, yeah, good point.
Think about the physical mechanics of this. What it practically means is that for every single dollar of merchandise that Dollar Tree sold, they kept 1.2 cents more in pure gross profit than they did at the exact same time last year.
Wow.
And when you scale that fractional improvement across billions of tiny individual transactions involving greeting cards, party supplies, canned goods, it translates to tens of millions of dollars falling straight to the bottom line.
So the scale just amplifies the microscopic improvements.
Percent.
But, that brings me right back to my original confusion. I still don't understand the physics of this. If your core shopper is actively having their disposable income chewed up by gas and groceries, how did Dollar Tree squeeze an extra 38% in earnings per share out of them?
Right.
Are they just price gouging their most vulnerable customers?
That is the logical assumption, but the data says something completely different.
Oh, really?
Yeah. The underlying mechanics of how they achieve this are what makes this particular earnings call so fascinating. To understand it, we have to look closely at the story driving those headline numbers.
Okay.
Let's go back to that 3.5% increase in comparable store sales. In retail, your comps are driven by two entirely distinct factors: traffic and ticket.
Traffic being the actual number of human beings walking through the automatic doors, and ticket being the amount of money those people spend once they are inside the building.
Exactly. And here is the jarring contradiction in the data. Foot traffic actually declined by 1% in the quarter.
Wait, fewer people came into the stores?
Yes. Fewer individual shopping trips were made to Dollar Tree locations compared to the previous year.
So fewer people walked in, but the store still made 3.5% more money. That means the people who did show up must have been spending significantly more.
They were. The average ticket size, the total amount rung up at the register per transaction, increased by 4.5%.
Wow.
Now, this was entirely in line with what management expected, but it reveals a massive structural evolution in how people are engaging with this retailer.
And this is where we really have to talk about the multi-price strategy, because this seems to be the engine of the entire quarter.
It is.
For decades, Dollar Tree had arguably the greatest, most pure competitive moat in the history of retail. The name on the building was the literal price of every single item inside.
Yeah.
You walk in with a $10 bill, you can buy exactly 10 items. It was a completely guilt-free, math-free treasure hunt.
But the macroeconomic realities of inflation eventually made that model impossible to sustain. They had to break the buck, initially moving their baseline price to $1.25. But what we are seeing validated in this Q1 2026 earnings call is that they didn't just stop at $1.25. They are successfully shattering the strict dollar barrier entirely.
But they have to be careful with that, right? I mean, if you suddenly walk into a Dollar Tree and everything is $4, it's just a slightly worse version of a regular grocery store.
Which is exactly why management went out of their way to explicitly note that approximately 85% of their sales mix still remains at $2 and below.
Okay, that's smart.
They are fiercely protecting those opening price points because they know that is what gets the customer through the door.
Yeah.
But that remaining 15%, that is where the margin magic is happening. They're bringing in what they call multi-price items, expanding into the $3, $4, and $5 range.
Like the $5 hammer. The CFO, Stuart Glendening, specifically joked about it on the call. They are successfully selling hardware for $5.
Yeah, that's pretty wild.
But it's not just tools, right?
Yeah.
For the everyday shopper, the multi-price strategy allows them to bring back beloved, recognizable name brands.
This is a crucial point about the mechanics of assortment. The CEO, Mike Creeden, gave specific examples. Brands like Rice-A-Roni, Spam, Frank's Red Hot sauce.
Yeah.
For years, as inflation crept up, Dollar Tree simply couldn't make the math work to sell a can of Spam for a single dollar.
Right, because you can't just negotiate infinitely with a massive vendor like Hormel. You can ask them to shrink the can to hit your price point, which is shrinkflation, but eventually the can gets so small, it's practically a novelty item.
Exactly.
It stops being a meal. So you just lose the item entirely. You lose the brand name from your shelves.
But because Dollar Tree opened up their pricing architecture to allow a $1.50 price point for certain center store food items, they were able to invite these major national brands back.
Which is huge.
And think about how that physically changes the shelf space. You go from having an aisle of off-brand, generic canned meat that the consumer might not trust to having highly visible, heavily advertised, trusted national brands.
I think about the multi-price strategy almost like a Trojan horse.
Oh, I like that.
Right. The $1.25 seasonal greeting card or the cheap party balloon is the wooden horse. That is the initial value proposition that gets the shopper to pull into the parking lot.
Yep.
But once they are inside the store, the $5 hammer, the $1.50 can of Spam, is the army hiding inside that actually captures the higher profit.
That is a fantastic way to visualize it. And consider the psychology of the shopper in that moment. Let's say you were making a specific trip to Dollar Tree to buy party supplies. You also need to go to the grocery store later to get hot sauce and dinner ingredients.
All right.
But suddenly, you see Frank's Red Hot sitting right there on the Dollar Tree shelf for $1.50. It's slightly more expensive than the traditional dollar item, but it's still highly competitive with the traditional supermarket.
You just toss it in the cart. Because gas is expensive, your time is valuable. You are consolidating your trips.
Trip consolidation is the exact behavioral shift management is banking on. The phrase the CEO used was, "Come for the holiday, stay for the everyday."
That's catchy.
Historically, Dollar Tree was heavily reliant on seasonal foot traffic. Easter, Halloween, Christmas. You went there for decorations.
Yeah, I definitely do that.
Now, through the multi-price assortment, they're capturing those seasonal transient shoppers and actively converting them into everyday grocery and household goods buyers. The customer doesn't feel the need to make that second stop. And instantly, your average ticket size just jumped 4.5%.
Okay, that explains the revenue side perfectly. They are getting the shopper to put slightly more expensive, highly relevant items into the basket. But I'm still stuck on the margin expansion.
Okay, let's hear it.
If they are selling more expensive name brand items like Spam, those items inherently cost them more to buy wholesale from the vendor, right? A $5 hammer costs more to manufacture and ship than a paper party hat.
Sure.
So where did the actual 120 basis point jump in pure profit margin come from?
To answer that, we have to pivot from merchandising strategy to the brutal operational reality of running 9,400 physical storefronts. The margin expansion wasn't just a byproduct of higher prices at the register. It was driven by a masterclass in aggressive surgical cost control.
Wow, okay.
There were a few factors. First, freight costs were favorable. The underlying cost of shipping goods across the ocean and moving them on trucks was lower than their internal models predicted.
Which makes sense, as the massive supply chain shocks we saw a few years ago have largely normalized.
Right. But the much more important factor, the metric that every single retail analyst on Wall Street watches like a hawk right now, is that management reported they are finally bending the curve on shrink.
Shrink, which is the retail industry's incredibly polite, sanitized corporate speak for theft, loss, and damage.
It is. And for the past few years, organized retail crime and internal loss have been absolute margin killers across the entire retail sector. It has decimated the bottom lines of companies much larger than Dollar Tree.
It's been wild to watch.
But Dollar Tree's management was very clear on this call. Their targeted initiatives to stop shrink are gaining real, measurable traction.
But how are they actually stopping it? Because we have all walked into certain discount stores and frankly, they can feel like a free-for-all. Things are disorganized, aisles are cluttered, and it doesn't feel like anyone is watching the merchandise.
That is the core of the issue. Management noted that they instituted what they call the non-negotiable audit.
Sounds intense.
It is. This isn't just about applying more security tags. It's a fundamental tightening of the basic operating standards of the store itself. They have focused heavily on product protection for higher risk items.
Does product protection mean they are locking the $5 items behind glass cases? Because that introduces a ton of friction for the shopper. If I have to find an employee with a key just to buy a hammer, I'm probably just going to order it online instead.
That is the delicate balance they have to strike, Product protection can mean locked cases for highly targeted categories like razor blades or certain cosmetics. But more often, it involves physically changing how things are merchandised.
How so?
It means line-of-sight merchandising, placing high-shrink items directly in the view of the cash wrap rather than buried in a blind spot at the back of the store. It involves applying much more deliberate inventory controls on at-risk categories.
Okay, so they aren't just building fortresses. They are redesigning the flow of the store to make theft inherently more difficult.
Right.
But it feels like it goes deeper than just moving the deodorant closer to the cashier.
It does. It goes to the overall operational standard of the store itself. To understand how they are bending the curve on shrink, you have to look at how management talked about their fleet of stores.
Okay.
During an Investor Day presentation a year or so ago, Dollar Tree leadership made an incredibly candid admission. They admitted that a staggering 42% of their entire fleet of stores was underperforming.
Wait, 42%?
Yes, they were actively operating below the company's own internal standards.
Which is wild to say out loud to your investors. You are essentially admitting that almost half of your real estate is failing.
It takes a lot of confidence in your turnaround plan to admit that publicly.
But think about what that means operationally. I always think about this using the analogy of a massive sprawling house.
Okay, let's hear the analogy.
Imagine you have a gigantic mansion, and 42% of the rooms are just a hoarder-level disaster. Trash everywhere, clothes on the floor, nothing organized. When you walk into a house like that, trying to clean it feels completely paralyzing. You don't even know where to start.
The magnitude of the disorder obscures the individual problems.
Yes. If the whole store is a disaster, if there are unpacked boxes clogging the aisles, if the shelves are disorganized and someone steals a handful of items, nobody notices.
Right.
It completely blends into the existing chaos. If a box of inventory gets lost in the back room, it's just another lost box. But management reported on this Q1 call that they have successfully brought that number of underperforming stores down to under a third.
They're actively instituting what they call their gold store standards. The CEO noted that turning around a fleet of 9,400 stores is a massive logistical undertaking.
I can't even imagine.
But as more and more individual stores get brought up to that gold standard, meaning they're clean, the shelves are fully faced, the lighting works, the backrooms are organized, the remaining problem stores become significantly easier to identify and manage simply due to the sheer volume of failure decreasing.
Exactly. It's the messy house. Once you get the living room, the kitchen, and the bedrooms pristine, spotting the mess in the hallway is instantly obvious.
Absolutely.
When a store is running efficiently, when the shelves are meticulously faced and every piece of inventory is tracked, shrink becomes immediately visible and actionable. The store manager instantly knows when a shelf has been swept of product.
Yeah.
That is how a non-negotiable audit actually works in practice.
Yeah.
A district manager can walk in at 6 a.m., look down an aisle, and immediately know if the standard is being met. They are bending the curve by cleaning the house room by room.
And the financial compounding of that cleanup is undeniable. This is a mechanism investors often overlook. When you lower your shrink, you don't just save the wholesale cost of the stolen or damaged item.
What else do you save?
You save the human labor cost of ordering it, unloading it off the truck, stocking it on the shelf, and auditing it. Every single dollar saved on shrink is a dollar of pure, unadulterated profit.
Wow, yeah.
When you combine that brutal operational discipline with the slightly higher average ticket from the multi-price strategy, you get the exact mathematical formula that generated a 38% increase in earnings per share.
So they absolutely crushed Q1. They proved the multi-price strategy works. They proved they can sell a $5 item, and they are methodically cleaning up the messy stores. They built a cash-generating machine.
They did.
But, if we are looking at this as investors, the stock market is a forward-looking mechanism. It doesn't care about the profit you made yesterday.
Yeah.
It only prices in what you are going to do tomorrow.
Very true.
So they've engineered this perfect Q1 machine, but if the machine is running so perfectly, why is management acting so cautious about the next 6 months? Let's look at the guidance. What are they actually telling Wall Street about the rest of 2026?
The forecast data they provided is fascinating, particularly in what it doesn't do.
Okay, lay it on me.
Let's start with the raw numbers. They raised their full year 2026 EPS guidance to a range of $6.70 to $7.10.
Okay.
They expect full-year net sales to land between $20.5 billion and $20.7 billion, with those comparable store sales expected to grow between 3% and 4% for the year. And for the immediate next quarter, Q2, they expect EPS to be between $1 and $1.15.
On the surface, raising guidance is always a positive signal. But if you read the transcript of the Q&A session with the analysts, there was some real skepticism.
There was, yeah.
Specifically, Seth Sigman from Barclays pushed back pretty hard on this. He essentially looked at the math and asked, wait a minute, you just had a massive historic beat in Q1. Why aren't you raising your full-year guidance by an equally massive amount? Where is all that extra Q1 profit going? Why are you hiding it?
It is a brilliant question from the analyst, and it highlights an important debate about corporate conservatism in a volatile macro environment. The management team is actively, deliberately choosing not to flow all of their massive Q1 beat into their full-year outlook. They are holding some of those chips in reserve. And the reason why is a masterclass in executive risk management.
Okay, let's explore the paranoia. What exactly are the storm clouds they are bracing for in the back half of the year?
They are bracing for two massive macroeconomic variables that are entirely outside of their control: fuel and tariffs.
Ah, okay.
Let's start with fuel. The CFO noted that when they originally built their financial models for 2026, they assumed the geopolitical conflicts in the Middle East would be a shorter-term temporal issue that would resolve relatively quickly.
Which didn't happen.
As we now know, that has not been the case. The conflict has extended, shipping lanes have been disrupted, and consequently, fuel prices have remained stubbornly elevated.
And for a company like Dollar Tree, fuel isn't just the cost of filling up the CDO's car. They import billions of items from overseas, put them on trains, and then move them across thousands of miles of American highways in diesel-burning trucks. Fuel is a massive systemic line item.
It is deeply embedded in their cost of goods sold. Now, while their base freight contract rates with shipping companies are actually pretty favorable right now, management is heavily baking in the reality of higher fuel surcharges for the remainder of the year.
Okay, how does that work?
Think about how a shipping contract works. You agree on a base rate to move a container, but there is always a clause that allows the trucking company to pass on a surcharge if diesel goes above a certain price.
Right.
Dollar Tree is assuming the worst-case scenario, the fuel stays high, and the company simply has to absorb those surcharges internally rather than passing them on to the consumer.
And what is the second storm cloud? Tariffs, which feels like it comes up every single earnings cycle for companies that import goods.
Yes. Dollar Tree imports a vast amount of its inventory, primarily from Asia. They stated on the call that they are taking a highly prudent, defensive approach to their tariff outlook.
Defensive.
They are assuming that current, relatively stable tariff rates will remain in place through July, but then they expect them to increase in the back half of the year, reverting to the higher levels that predated a specific February Supreme Court decision.
Let me make sure I understand the strategy here, because as an investor, reading between the lines of guidance is everything. They are actively baking all these worst-case scenarios, high gas, higher shipping surcharges, elevated tariffs into their models, which naturally suppresses their full-year earnings guidance.
Exactly.
But they also explicitly mention something about tariff refunds, right?
That is critical detail that completely changes how you view their guidance. Like many major importers, Dollar Tree is currently participating in a complex government tariff refund program. Essentially, they overpaid certain tariffs in the past and are owed money back.
Oh, nice.
But because the timing of government bureaucracy is completely unpredictable, and the exact dollar amount of those refunds is uncertain, the CFO completely zeroed them out in the guidance.
Wow, really?
He essentially told Wall Street, if we get these refund checks, great, that is pure upside. Well, we are not going to promise you money that isn't sitting in our bank account yet.
This is exactly what I mean about the physics of this quarter. If we look at this holistically, Q1 was so incredibly strong that it basically handed Dollar Tree a giant financial shock absorber.
Yes.
It gave them the luxury of looking at the rest of the year, seeing all these terrifying variables, geopolitics, diesel prices, trade wars, and saying, you know what, even if every single one of these bad things happens exactly as we fear, we are still going to raise our full year guidance slightly because our core business is running that efficiently.
Yeah, they generated the margin of error required to absorb macro headwinds without the stock price getting absolutely punished.
That's incredibly smart.
It shows a management team that is deeply focused on building a resilient, predictable business model. They aren't interested in chasing short-term stock pops by promising the moon to analysts. They are managing expectations brilliantly.
And Wall Street usually rewards that in the long run.
Definitely. And the CFO even hinted at the underlying leverage. He told the analysts to keep in mind 3 potential avenues for pure upside to this guidance.
Victor.
1, if the Middle East conflict de-escalates and oil drops, that's upside. 2, if the lower tariff rates unexpectedly extend past July, that's upside. And 3, if they do get those tariff refund checks from the government, they plan to take that cash and reinvest it directly back into the business, which would spin the growth flywheel even faster.
It is the ultimate under-promise and over-deliver setup, which brings us to the most important part of this deep dive. We've looked at the data, we've translated the jargon, we've explored the multi-price mechanics and the shrink initiatives. Now it is time to take a stance.
Let's do it.
If I am looking at my portfolio right now, what is the ultimate takeaway? For this deep dive, based on the totality of the evidence in this earnings call, we are taking a decisively bullish stance on Dollar Tree.
It is very difficult to look at the granular results and the operational maturity demonstrated by this management team and come away with any other conclusion.
I agree completely.
But the bullish thesis really hinges on 2 massive structural shifts that we need to explore in depth. The first is an operational victory that might be the most impressive metric in the entire transcript.
I'm looking at the numbers. Is it the inventory management?
It is absolutely the inventory management. The CFO revealed that their total inventory declined by 9% year over year.
Okay, stop right there. I don't understand how the physics of that work.
It sounds counterintuitive, I know.
How do you increase your total sales by 7.2%, but you have 9% less stuff sitting in your warehouses and back rooms? If you are selling more, shouldn't you need more inventory on hand to prevent empty shelves?
That is the traditional retail mindset. But what Dollar Tree achieved here is the holy grail of supply chain operations. It represents incredible working capital efficiency. Let me break down the mechanics.
Please do.
The CFO pointed out that if their inventory had simply grown in lockstep with their sales over the past 12 months, meaning if they held the same ratio of inventory to sales as they usually do, they would be carrying an extra $425 million in inventory right now.
$425 million. That is nearly $500 million. That would just be sitting in cardboard boxes, gathering dust, taking up physical space in distribution centers, and completely tying up the company's cash.
Exactly. When cash is tied up in inventory, it isn't doing anything for the business. It is trapped capital.
Right.
But because they aggressively unplugged the system, improved their logistics, and forced their inventory to turn over at a much faster velocity, they freed up that trapped cash. They sold the items before they had to pay to store them for long periods.
And when you free up $500 million in working capital, that money has to go somewhere.
It flowed directly into their cash generation. By running this lean inventory model, they generated $644 million in cash from operations. And after you subtract their capital expenditures, the money they spent on building new stores, remodeling existing ones to the gold standard, and maintaining their supply chain, they produced $392 million in pure free cash flow in the first quarter alone.
That is a staggering figure. A business that built its empire selling $1.25 greeting cards and cheap seasonal decor just printed nearly $400 million in pure, unrestricted free cash in a span of 90 days.
Yeah, it's pretty impressive.
And what did they do with that cash? They didn't just sit on it. They bought back their own stock. The call noted they repurchased about 5.5 million shares for $595 million in the quarter.
Which is a highly efficient use of capital. Over the past 12 months, they have systematically reduced their total outstanding share count by roughly 8%, returning $1.7 billion directly to their investors.
And we need to explain why stock buybacks are so powerful here.
Yeah, let's break that down.
When a company buys back its own stock and retires those shares, it acts as a natural accelerant for earnings per share. Even if the company's total net income stays exactly the same, your EPS goes up because you are dividing that massive pool of profit across a smaller and smaller number of outstanding shares.
Every remaining slice of the pie gets mathematically bigger.
Exactly. It is financial engineering, but it is supported by a fundamentally sound operational engine. However, beyond the inventory management and the share buybacks, the long-term bullish case rests on the second structural shift, their proven pricing power, and the changing demographics of their customer base.
You were talking about the trade down effect.
Yeah.
This was a specific dynamic brought up by one of the analysts on the call. And I think it is the most fascinating sociological shift happening in retail right now.
How so?
The theory is that when the macroeconomy gets tough, economic gravity starts pulling shoppers down the retail ladder.
Yes. The people who usually shop at high-end, premium grocery stores start feeling the pinch, so they trade down and start doing their weekly shopping at mid-tier supermarkets.
Right.
The people who historically shopped at those mid-tier supermarkets start feeling the inflation, so they trade down to big-box discount stores.
And Dollar Tree is perfectly positioned at the very bottom of that ladder, ready to catch the downward flow of that economic gravity. But they aren't just catching the lowest income shoppers anymore.
Which is the crazy part.
The CEO explicitly stated that their customer base is increasingly including higher income cohorts. He noted that more than half of their households now skew higher income.
Which is a profound shift for a brand that built its identity on deep, deep discount shopping.
But think about the psychology of it. If you are a household making $100,000 a year, historically, you might never set foot in a Dollar Tree. It wasn't for you.
Right.
But suddenly, your mortgage payment went up because property taxes increased. Your car insurance skyrocketed. Your regular grocery bill doubled over the last 3 years.
Yeah, everyone is feeling it.
You still make a good salary, but your disposable income is vanishing. Suddenly, the idea of walking into a Dollar Tree and buying a name brand bottle of Frank's Red Hot for $1.50 instead of paying $4 at your local supermarket doesn't seem like a bad idea at all.
It feels smart.
It is what the CEO called the guilt-free treat-yourself mentality.
And the multi-price strategy we discussed earlier is exactly what facilitates this trade down. If a six-figure earner walks into a Dollar Tree and only sees weird off-brand hot sauce they don't recognize, they might walk right back out. The friction is too high.
Exactly.
But because Dollar Tree broke the buck and allowed themselves to stock trusted national brands, they normalize the experience for that wealthier shopper.
What's fascinating is that the internal data supports this sociological shift completely.
Oh, yeah.
The CFO noted that when they look at their store performance broken down by the income demographic of the surrounding neighborhood, all of their cohorts are comping positive.
That is incredible.
It is incredibly broad-based growth. They aren't just surviving by squeezing their most vulnerable, lowest-income shoppers. They are actively winning over the middle and upper middle class who are desperately seeking value.
So if I am synthesizing this into the ultimate takeaway, if you are currently holding DLTR, or if you are considering adding it to your portfolio, this Q1 earnings call is a blaring siren of a strong signal.
Definitely.
It proves that the company's multi-price turnaround, the great risky experiment of breaking the dollar barrier, is not just a whiteboard theory anymore. It is actively, demonstrably working.
They are operating as a highly defensive stock in an offensive posture.
I like that phrasing.
They have demonstrated the ability to generate massive free cash flow, aggressively improve their internal operations by lowering shrink and cleaning up their messy stores, and physically expand their profit margins even when the broader macroeconomic environment is incredibly shaky.
They are controlling the controllables, which is exactly the trait you want to see in a management team when the world outside is chaotic and unpredictable.
Completely agree.
Okay, as we wrap up this deep dive, I want to pivot and leave you with a final provocative thought. We've spent a long time exploring why the multi-price strategy is brilliant, but let's stress test the future.
It is important to remember that every strategic pivot introduces new vulnerabilities.
Always.
The expansion into multi-price failures, the $5 hammers, the $1.50 name brand groceries, the $3 home decor items is clearly the engine of their current success. But it begs a massive strategic question for the long term.
Right, because Dollar Tree built a multi-billion-dollar empire on a very specific, deeply ingrained psychological phenomenon, the pure guilt-free treasure hunt.
Yeah, the thrill of the deal.
You could walk in with a $10 bill and feel like an absolute king. You didn't have to look at price tags. You didn't have to do mental math because you knew what the price was. Everything was a single dollar.
It was the lowest friction shopping environment on the planet.
But now they are thriving by deliberately introducing friction into that environment. You have to check the price tag now. Is this item $1.25? Is it $3? Is it $5?
It changes the entire cognitive load of the shopping trip. As they increasingly rely on these items above the $1.25 mark to drive their revenue growth and their margin expansion, do they risk eroding that ultimate competitive moat?
Exactly.
Or they lose the magic that made them special in the first place?
Because as they move their assortment upmarket to capture that higher income trade down shopper, they are stepping directly into the ring with absolute retail leviathans.
Yeah, the big guys.
If I am going to Dollar Tree to buy a $5 hammer and $4 name brand groceries, they are no longer just competing with the independent dollar store down the street. They are increasingly asking the consumer to compare their prices, their store experience, and their assortment directly against Walmart and Target.
And that is an entirely different, incredibly dangerous weight class to fight in. Walmart and Target have supply chain efficiencies and economies of scale that Dollar Tree simply cannot match.
They just can't.
It is the classic innovator's dilemma applied to discount retail. You move upmarket to chase better margins and wealthier customers. But in doing so, you leave your flank exposed at the bottom and you face significantly better resource competitors at the top.
It is a precarious tightrope to walk. So, going back to where we started this entire conversation, the physics of retail. For this specific quarter, Dollar Tree completely defied gravity.
They really did.
They took an active, painful squeeze on their core consumer and somehow produced a massive, explosive reaction in profit. They built a better machine. But economic physics always catches up eventually.
Always does.
Can they maintain this delicate balance of higher prices while preserving the joy of the treasure hunt? Or will the immense gravity of Walmart and Target eventually pull them back down to earth? That is the narrative we will be watching closely next quarter.
The transition from a single-price discount store to a multi-price value retailer is one of the most complex maneuvers in modern business, and Q1 shows they are executing it at a very high level.
Thank you for joining us on this deep dive into the numbers, the strategy, and the mechanics of Dollar Tree's first quarter. Remember to stay curious, keep questioning the narrative, and always keep seeking the story behind the ticker. Until next time.